uncertainty has left few easy options for investors. It seems to come down to a choice between high-risk assets or overpriced havens. Our next guest says the dilemma is not going to disappear anytime soon. But William de Vijlder says there are alternatives. He oversees more than €500 billion as Global Chief Investment Officer of BNP Paribas Investment Partners, and he joins us now. William, thank you for coming in. What are the alternatives? Because actually I was speaking to an investor earlier on. He says, well, I'm taking full risk now because the havens are so overcrowded that I need to be somewhere else, and it looks like the riskier assets now at least give better returns.
Yeah, I understand the rationale. The problem is that we have completely antagonistic scenarios. So it's either boom or it's bust. Now, boom is a slight exaggeration. So it means that the importance of making the right forecast is incredible. And that is why when I'm saying looking at alternatives, is really to say, well, look at it more from a relative basis, to say, for instance, go for US instead of US in European equities, because Europe is really suffering, obviously, from the Eurozone crisis. Within bonds, for instance, look more towards emerging markets, which have already had quite a sell-off on the currency side, and where spreads have also widened, and where growth is more robust, and balance sheets are healthier. And that is, it's taking risk, but it's less risky than just going all out, for instance, in equities or all out in the overpriced safe havens.
And I just want to leave emerging markets to one side because we'll come back to that in a little bit of detail. But how do you actually pick the companies? Is it through industry sectors? If you look, for example, at the US, are you going for corporate debt? Are you going for dividends? Are you going for those companies that even in a recession will give something back to shareholders?
Yeah, the overriding thematic in managing our equity portfolios is quality. That's what we go for. So it's really dominating the sector team, because the sector team is very much driven by beta on, beta off trade, so risk on, risk off trade. So it's really going for quality. When we're talking to clients who have to figure out what type of sector, what type of equity exposure they want, our recommendation is to go for, again, quality and high dividend stocks.
But quality, so this is what, stock picking almost. Does it have to be, do you have to hold that stock for a longer term? Is this how you get rid of all that volatility out there? Because the US equities are looking maybe a little bit cheap and valuations seem good, but they're also seesawing all over the place.
Yeah, that's correct. I think the only way of, let's say, coming with a clear decision is to say, I have to lengthen my horizon a little bit, because otherwise you're just kept hostage by very short-term volatility in the market.
So in terms of how you actually break down your portfolio, how much, in terms of percentage-wise, how many companies do you want that give you high dividends, or at least dividends?
Well, it depends on an equity portfolio or an overall portfolio. So within equity portfolio, we're going for the high quality, and so that's clear. And because that is where we are most comfortable, that's also where you can take a more medium-term horizon. When you're looking within an overall portfolio, then we would more play the regions, but also having a high income bias in the portfolio. It also depends, of course, on what kind of risk budget the client is giving us. More risk-averse clients, we would put more into high income.
And where does the UK come into all of this? Because they have a lot of stocks that are dividend-rich, and they're putting the austerity measures through, so at least they're getting away from all the madness that is peripheral Europe.
Yeah, I think UK is really interesting from a kind of policy test perspective. I think the big attraction that the UK has, it has policy flexibility on the monetary side, and because it has a floating currency. Pick any Eurozone member, you do not have that policy flexibility. So going all out in addressing the budget issue whilst doing another round of QE, which will come, and having a floating currency, I think that's an attractive combination. Would also mean that equity investors internationally would be attracted to the UK market because of that flexibility.
Now, William, you also say that emerging markets debt, of course, and selected equities, and you single out China, for example, to be among the most attractive options. I just like to consider this in light of a new survey that was done by Bloomberg, and it shows that 59% of investors think that growth will slow to less than 5% by 2016. Almost 50% of those polled also think that this will happen in the next 2 to 5 years. And so some think that such an outcome is just around the corner. 12% predict that the growth rate will be cut in half within a year. So now do you think that it's a cause for concern that growth is actually slowing, or does it just rule out a hard landing?
Yeah, I think you have to look at it, you have to differentiate between the medium-term picture, like say for the coming 5 years, and what you want there is to have a kind of a gradual soft landing to come to a more sustainable growth rate, because otherwise you would run into all sorts of constraints, be it commodity, be it pollution, what have you. Also, it's not normal that an economy would continue of that size would continue to grow at that pace. So the silver lining is that commodity prices would not become the kind of speed limit on the growth. Short term, the thing you have to avoid is that it would be kind of a falling of a cliff phenomenon. If you would have a halving of growth next year, then of course that's tremendous. It would trigger policy intervention after a big growth scare. And I think the last thing that we would need to have now is that on top of the Eurozone problem, on top of the US worries, that we would have worries on China as well.
Yeah, that's the last thing we need. You're absolutely right. Well, thank you so much. Thanks again for joining us. William de Vijlder there, the Global Chief Investment Officer at BNP Paribas Investment Partners.